What is a 2-1 temporary interest rate buy down? Hey everybody, thanks so much for joining me today. I am Jeff, the Mortgage Pro, and today we're going to be talking about one of these so-called new products that you're hearing about in the real estate world. It's actually not very new. It's been around for 20 years or so, maybe even longer than that. And it just hasn't been in use over the last several years because of the low nature of interest rates. Well, what happens when interest rates skyrocket? We try to find solutions to help borrowers make more affordable payments on their loans every month. And this 2-1 temporary buy down happens to be a really, really great idea to use, especially in the market where interest rates have been increasing so much. So let's take a look at it. A 2-1-0 interest rate buy down. If we look at the numbers in this example, the 2 stands for the first year's reduction in interest rate. So we're going to reduce our note rate by 2%. And then the second one is the 1, and that will be the second year's payment. It was going to be reduced by 1% interest. And then the third through the 30th year has a 0% reduction in interest rate. So a 2-1-0 buy down, or a 2-1 buy down as it's more commonly called, interest rate is reduced by 2% the first year, 1% the second year, and then 0% the years after that. A couple things to go along with this. This is for Fannie Mae and Freddie Mac loans, including high balance and super conforming for those high cost areas, but it's only for a 15 or a 30-year fixed. You can't use it on any type of an ARM product. This also works for Ginnie Mae loans, which are VA and FHA conforming loans. You cannot use an FHA high balance, or you can't do a VA high balance loan with this particular buy down product. It is for purchases only. It is for your primary residence only. You have to qualify at the fully indexed note rate, which is what you usually have to qualify on any type of a mortgage that you're going to get. And then the eligible properties that are available for this particular loan: a single family residence, a condo, a townhome, a PUD, and even multi-unit properties are available for this temporary interest rate 2-1 buy down, which I think is really, really cool. So as long as you live in one of those multifamily units as your primary residence, you could use this temporary buy down to be able to buy that particular property. Okay, so cool things there. Let's take a look at an example of a 2-1 buy down in action. So in this example, you can see that I have a $400,000 loan amount in there, and our note rate that we're going to have on this particular loan is 7%, and our term is a 30-year fixed loan. Our monthly payment, $2,661 per month. So with a 2-1 buy down, you can see that in year 1, we're going to reduce our interest rate 2%. So it goes from 7 to 5% for that first year. Your monthly payment would end up being $2,147 for that first year. The second year, it's reduced by 1%. So it goes down to a 6% interest rate. And your monthly payment would then be $23.98 for that whole second year. And then years 3 through 30 would be at the full note rate again, which was the 7%, so $26.61. So you can see that there's a monthly subsidy. That's the difference between the full note rate payment and the buy down rate payment. So for example, in year 1, the monthly subsidy is $513.92. And then in year 2, the monthly subsidy is $263.01. So if we add those up for 12 months each, we get a yearly subsidy in year 1 of $6,167.04. And then in year 2, $3,156.12. And if you add those two together, you get the total subsidy that we need. And I'll explain that here in just a second. But the total subsidy ends up being $9,323.16. Now, what this number is the contribution that the seller or the lender or both can make in order for you to be able to do this 2-1 buy down. Most commonly right now, we're seeing it on the seller's side, where they are contributing that amount of money to be able to help buy down that interest rate. So It's a temporary rate buy down, which is a little bit different than a permanent rate buy down, which we'll talk about in another episode. But I think this is really cool, and it's a great thing to use. So one of the questions that keeps coming up that I hear from a lot of people is, what happens if interest rates drop in that first 2 years that I have the loan, and there's still an amount of money that's left over that can be used to buy down the interest rate? So what we can do in that instance is you can pay off your loan early. That remaining balance will then be paid down on your principal balance so that you reduce your principal balance by whatever amount is left over with this remaining subsidy. So it's a win-win situation all the way around whenever you're able to use this, because a seller is going to be able to sell a property in a tough market. You're going to be able to get a benefit of a reduced payment for the first couple years of your loan. And if interest rates drop, you still get the benefit that you can reduce the principal by X amount of dollars, and you can get that new interest rate, hopefully at a lower interest rate down the road when the rates come back down. Thanks so much for watching. Hope you understood.